Hi, I'm Martin Pring, and I really would like to welcome you to this series of technical analysis tutorials. In these presentations, we'll be covering the basics to better equip you as traders and investors. As always, I suggest that you hit the subscribe button, because from time to time I'll be coming out with more educational videos. And when the opportunities present themselves, for some market timing situations. There is, of course, a lot more information at my website, pring.com. But enough of the commercials. Let's get started. And this session is entitled The Basics of the MACD. So without more ado, let's get started. MACD stands for Moving Average Convergent Divergent and was developed by Gerald Appel many years ago. It's essentially a moving average system, and it works as follows. The initial step is to calculate a 12-period EMA, or exponential moving average, of the data in question. Since this is a daily chart, the EMA is a daily one. The next step is to calculate a 26-period EMA. Finally, the shorter EMA is subtracted from the longer-term one, and the result is an oscillator. You can see here that when the short-term series crosses below the longer-term 26-period EMA, the MACD crosses below zero. When the 12-period EMA is well below the 26-period series, an oversold reading is generated, and when it's well above, an overbought condition is registered. There's one other element, and that is the so-called signal line. The signal line is a 9-period EMA that is run through the MACD itself. When the MACD crosses above its moving average, i.e. the signal line, buy and sell signals are generated. Now, of course, these are only momentum buy and sell signals, and since we cannot buy and sell momentum, it's always important to make sure that the price confirms with a trend break of its own. That could be a trend line break, a price pattern completion, a reversal in peak trough progression, or a moving average crossover. Let's take a look at that point in greater detail. These green and red arrows approximate the momentum buy and sell signals, where the MACD crosses the signal line. In this instance, they all work pretty well, except for this buy signal. The reason was that it was not possible to construct a nice trend line on the price. Okay, I could have put this one in, but it's extremely steep and therefore unsustainable. However, these lines were much better, and their violations resulted in some nice signals. This signal didn't work out either, because there was no trend break there. Also, it came when the oscillator was deeply depressed, and except in the most bearish of trends, oversold sell signals are not likely to work. Neither, of course, are overbought buy signals. Finally, this chart features a positive divergence, where the price makes a new low, but not the oscillator. This is a bullish sign that once again needs to be confirmed by the price, and in this case, it was. Incidentally, my video on momentum more fully describes the concept of divergences. This example using the medical device ETF is a bit unusual because it leaves you with the impression that signal line crossovers are usually followed by a sustained reversal in trend of the MACD. Unfortunately, in the real world, a lot of these crossovers turn out to be whipsaws or false signals. That, of course, is another reason why you want some backup from the price trend reversal as confirmation. This chart, for instance, shows perhaps the best measure of the global equity market, the MSCI Global ETF, the ACWI. Underneath is its MACD indicator, and these ellipses show the huge number of whipsaw signals that it triggered in this relatively short time period. In my video on momentum, I also talked about overbought oversold conditions, and these can also be applied to the MACD. In this chart of the Goldman Sachs software ETF, I've introduced some overbought oversold lines at plus and minus 1.0. Without regard this time to price confirmations, here are the good sell signals. And here are the sell signals that were followed by a very mild sideways correction. Since this chart mainly covers primary bullish periods, the buy signals are generally much more timely. However, if I uncover some more price action, you can see that on rare occasions, any momentum indicator, where the formula does not restrict extreme movements, can literally move off the charts. The moral of the story is just because an indicator is deeply oversold, don't assume that it cannot become even more oversold. Another reason why we need to make sure that momentum buy and sell signals are backed up by price trend reversal confirmations. In summary, 1. The MACD is a moving average system where an oscillator is derived by subtracting a shorter-term moving average by a longer-term one. 2. Buy and sell momentum signals are triggered by signal line crossovers. 3. Overbought oversold conditions and divergences can be applied to the MACD. And 4. Make sure that any MACD signal is confirmed by the price. If you'd like to watch and read a much more in-depth explanation of a multitude of momentum indicators, including the RSI, MACD, and stochastics, then you will profit from my definitive guide to momentum indicators, a 42-chapter, just under 500-page workbook CD combination. This package comes complete with a 10-hour audio-visual tutorial, just like this presentation, as well as an interactive quiz, so you can test your own knowledge. Details of this and our other tutorial DVDs, newsletters, seminars, and conservative money management programs can be found at our website at pring.com. In the meantime, good luck and good charting.